and we'll have plenty networking time after as well. So just don't want to keep everyone waiting. I know some of you guys have been here since like 5:10, so you've been here for a while. So before we get started, we'll just introduce the host, which is me and Brian. I'll start with myself and a little bit about the group as well. So this is the first ever commercial real estate meetup in Northwest Arkansas. We really deserve a commercial real estate meetup because we're consistently rated as number 7 top-rated best living cities in the U.S. So there's a lot of growth happening. Commercial real estate is growing. We're really going to meet up. And my vision for the meetup is, once we get to 200 people, maybe we can start a tri-state conference in the area. Maybe, having folks from Missouri, Oklahoma, Arkansas, we all gather. We deserve the attention. So why are you listening to me? Well, my name is Micy Liu. I'm the founder and managing partner of Life Mission Capital, a private equity firm focuses on helping high net worth individuals passively invest to get to their freedom and legacy goals. So some of the assets we focus on multifamily, short-term rentals, mobile home parks, build to rent, a little bit of everything, where I leverage my due diligence background using data analytics skills to help provide a white glove service. I'm going to pass it on to Brian now, and we're using this because we're also recording it. There's folks that can't make it tonight, and there are folks outside Arkansas that's really interesting what we're doing. So we want to let them hear about what we have to say as well. So pass it to you, Brian.
Well, awesome intro, Micy, and really appreciate you putting this together. It's one thing, I've been thinking about doing this for a long time, but it's one thing to think about something and actually to put it in action. So I appreciate you pushing this to the finish line. I guess I'm kind of the apartment guy here. I started buying apartment complexes here just a couple miles down the road in Springdale with a little 12 unit about 6 years ago. And I built up a portfolio of about 66 doors that I own myself. And from there, I knew I had to grow. So I partnered with my father-in-law, who's also here, on another 450 doors from Rogers all the way to Fort Smith. And then from there, I also knew that there's only so much inventory here and only so much I could do with just the two of us. So I grew outside of here, started buying apartments in Dallas, Houston, South Carolina, Florida even. So now I'm a general partner on a larger syndication firm where we're buying thousands of units a year. So yeah, I'm really excited that you guys are here. I get to introduce our first guest speaker, Zack. Kifer was super instrumental in my growth 5 years ago. We've done probably over $20 million of, maybe $50 million of volume together, buying and selling apartments. He's helped me buy apartments. He's helped represent me sell apartments that we've gone full cycle here. So beyond just apartments, he's also worked on really cool projects. You guys might know if you're in the Fayetteville area, Tin Roof, he helped put that together down on Dixon Street, and a lot of other cool things here in town. So definitely the guy I asked for any questions outside the apartment space. So happy to introduce Zack to come speak today.
Thank you for the intro, Brian. What's up, guys? How are we today? Good. So really just going to go through a couple case studies today, open for questions, super informal. Just kind of want to give you guys an idea of 2 products that I've done deals on in the recent future or recent past. Let's go through this, yeah? Speaking a little bit about Moses Tucker, yeah, I'll go into that. My firm. So I started in real estate as a junior in college, worked for a Little Rock company called Flake & Kelly. Was there 3.5 years, got the opportunity to open Moses Tucker's office, which is a Little Rock-based kind of boutique commercial real estate firm. 6 years later, I am one of 2 partners in our firm. We've got just under 100 people here in Little Rock, 8 million square feet under management, which is the second largest firm in the state, and do a lot of retail, do a lot of office, a lot of multifamily with Brian. Haven't dipped in the industrial game too much. Super tight market here. But let's go ahead and get into a couple of these case studies. Oh, let's talk about this too. So this is a couple projects my firm has developed here in the state. So first off, we've got the 8W Center right next to the Walmart home office. Mixed use, was a retail food court. COVID ended that. We now have an engineering firm to take the entire first floor. So now it's a strictly office. That is for the Jack Beef Jerky family, super successful. The 8th Street Market, you guys have probably been there. Food court, food, as well as the Brightwater Health Institute. Pretty cool mixed use there as well. El Dorado, cool boutique hotel. Condo project, 303rd and River Market Tower in Little Rock. That's where Moses Tucker got their start, if you were wondering, was revitalizing the downtown River Market in downtown Little Rock. Distillery, very cool project in East Village, same here. We can go on that, those are Little Rock projects. So this is kind of my bread and butter, is the single tenant net lease stuff. Developing Slim Chicken, Circle K, Starbucks, Taco Bell. Typically that's a franchisee that is our client rather than the corporate client. So say K-Mac is one of ours, Taco Bell. They have roughly 325 locations across the South. So basically we come in, they give us a target market. We find, 5-10 sites that may work out. Put one under contract. It's about a 12-month process. And a lot of times they're trying to do a sale leaseback situation. So a lot of these fast food groups do not want their capital tied up into real estate. They would rather have it in operations. So they basically, let's go to the next one. I'll show you. So here's an example of a King Burrito. So the big thing to look at here is the rent factor. This is your build-to rent factor. So you compare that with the cap rate you think it will sell at. So cap rate is really a single tenant net leased is based off the tenant's credit. So the better the tenant, the lower the cap rate. The worse the tenant, the higher the cap rate. So on average, a Taco Bell is selling like 4.25. So we thought at least, King Burrito is not Taco Bell, right? You've got, I think we've got 10 locations instead of 325. So the real trying to figure that out is what an investor would be willing to pay on a cap rate basis. And so we thought, go to the next one. Right here.
Yeah, so it's hard to see the light with plan on being at 7 and it's a bit easier to see that.
You're good. So that rent factor was basically 9.5. This is 7.25 is what we think the exit could potentially be. So your developers are always looking for that 2-point spread. A lot of these are open book approaches. So these tenants have preferred developers. It's an open book system. It's not like you can get these preferred relationships and build a 10 cap and sell it at a 4 cap. You're building it at a 6 cap and selling it at a 4 cap, which just means you're making less money. But it's pretty much a guaranteed coupon for a lot of corporate, a lot of just heavy cash investors there. When they buy these things at 4.25, right, if they put debt on it, it'd be a negative leverage deal. So it's really cash buyers, but on this one specifically, we'll run through it. So project cost, $1,060,000. We bought the building for $850,000. We gave the tenant $100K to put into the building as far as renovations go. And then there was roughly another $100K in soft costs between commissions. Let's go one more slide. So here's your soft cost. So pretty much every commercial deal like this, you're going to want a phase 1 environmental, $1,500, checks to make sure no environmental contamination on the property whatsoever. If you get through that, you're in the clear. If that brings something up, you then have to get into a phase 2 environmental, which is a lot more intrusive. You're looking at 5 to 10K, as well as more than a month, 30 days to work through that process. You also want to get an updated Alta survey, make sure there's no encroachments on the property, make sure all the access this is good. Nothing that's going to surprise you at closing. And then you've just got some soft cost appraisal report, just like you would have on a house. Legal fees, closing costs. There's your tenant improvement allowance, $100K. Leasing fee is $60K. And then you throw in a little contingency. So right here, 30 a foot. So we had some comps, what a King Burrito had sold for before, trying to figure out that cap rate. And so there was one in Tawnytown that sold at a 7.4. Remember, we're at a 9.5. We're wanting to get 2% on this. So that one checks the box. That one checks the box even better. It's a 6.9, and that's on MLK in Fayetteville, which is like fast food row. So you're always going to get a better cap rate there. And then 7.5 on another one in Tulsa. Let's go to the next slide. Well, go back. Go back. Yeah, there we go. So you can kind of see down here, our planned exit at a 7.25, which would have been 2.25. Yield was 1.4. We actually sold this for 1.5, so it ended up being a 6.75. So we got 2.75% on the yield. So pretty awesome deal. Single tenant net lease deals, the reason they're so attractive, zero landlord obligations whatsoever. Tenant pays for the insurance, tenant pays for the taxes, and tenant pays for all the maintenance on the building for the extended period of the lease. You just get that $100K a year in your check. You get the depreciation benefits. It's a pretty sweet space to be in. It's just kind of super tough to get within because a lot of these retailers have their preferred developers. But we were able to find a vacant Hardee's in Siloam. Knew that they were wanting to grow, so plug and play. Let's go to the next one. Anybody have questions on that?
Okay.
Yeah.
So with this smaller franchise like King Burrito, if you didn't have as many comparables, what would you pull?
So it's tough. It's tough. Yeah.
Like similar franchises of the same size?
Correct. Yes. That's where you can. Yeah. So. Yeah. Repeat the question.
If you, with another small franchise, if you didn't have as many comparables for that exact franchise, what would you pull to find it?
Okay. So the question is, if it's a similar type concept, size-wise, trying to do a deal based off the same type of credit as a similar tenant, it's really your market's going to determine it more than anything. We try to get, every restaurant, Omar can maybe speak to this as well. This is my experience, trying to get 7% of their revenue to be their rent factor. So say $100K, $1 million, they're trying to get, if they're doing 1.5 a year, 7% of that is, what is that? It's roughly $100K. So that's a little bit, you can't just charge an enormous amount, as far as rent goes. So it would be based off the predictions of the restaurant user along with your market. And you just try to tee those up together as much as possible. Does that answer your question? Cool. Let's go to the office redevelopment. So this is one that took about 5 years of my life. Great project, cool. Let's go one more page. Before and after, there you go. So this is roughly 2016. This is 2021. This was greatest deal I've been a part of to date. Most profitable, super cool. Can't believe somebody didn't do it before we did. Basically, this building was out of date, out of touch, very tired. When we look at this, we look at a few different factors of where we can bring some value add situations. So say one, occupancy is 40% vacant. That was one tick we thought we could get. Two, under market rents. It was at $14 a square foot. We thought the market was $20 a square foot. No triple net leases, all full service. So instead of landlord not having to pay anything, he's paying everything. What else do we have there? Downtown Fayetteville, right on the square. Yes, the common area. That's one of the coolest things about this. So, right, office buildings got hallways, back patios, just empty space throughout the building that's still under a roof, right? Well, there's a difference between rentable square footage and usable square footage. Usable is the space that you're in. Well, in this situation, you can create a load factor. So every tenant, this load factor was 1.185. So to cover that common area expense and still get income on it, you basically come up with this load factor, 1.185. So every tenant in the building, their square footage, 1.185. You times that. And so basically, if you're in 1,000 square feet, you're paying for 1,185 instead of 1,000. That covers 9,000 square foot of empty space, which comes down to your bottom line and gives you 20 a square foot times 9 in your annual NOI added to it. So it can be super attractive. Key to that is short-term temporary leases when you buy it, because if they're 5-10-year leases when you buy it, you don't have any flexibility to change any of that. So those are just a few points on where we thought there was some value there. Let's go to the next one. Next one's cool. Next one. So I changed these a little bit just as FYI. I couldn't share the exact numbers, but so we bought this for $3.25, 2016. I'll pull this up. So at 50,000 square feet, which is roughly what the building is, 60% occupancy, that means you're only getting rent on 30,000 square foot of the building. The average rents were 14. And so your annual rent's $420K, your OpEx is 7 a foot. So then your NOI is $210. Well, if you come in, we put $2.5 million into this. So $3.25 plus $2.5, we're at $575. We were able to up that occupancy to 90%, which is 45,000. We're able to increase the rents to 20, which got the rent from 420 to 900. OPEX, you've got a little bit more because you have more tenants operating in the building. That went from 210 to 315. And so then your spread is 13 a square foot or 585K in NOI rather than 210. So all of that to say, it's a $5.75 million difference with a $2.5 million investment. So, we put $3.25 in and we got $3.25 out as profit. So pretty sweet deal. This is a true value add opportunity. Wagers and I hit pretty much every value add apartment in Springdale over the last 4 or 5 years. It's kind of picked over. That's the unfortunate part about it. But there's still some opportunity there. And I think with today's market, there's going to be even more opportunity. Let's go to the next slide. Yeah. Let's go to the next one. So this is the rent roll. So this is every tenant in the building. This is what type of lease they're on. You'll see this in any commercial property. This is kind of your standard bread and butter other than the P&L. This shows you who your tenant base is. You've got lease type, full service. You'll see there's one being converted to a triple net. So that's eventually the plan for each of these tenants is trying to convert them to that, which just unlocks additional income for us. You got your square footage, you got your lease start, your lease date. In the commercial space, your average lease, I would say, is 5 years, but they range from 12 months to, I've done a 25-year deal. So a little bit across the board there, but 5 to 10 years on all these office deals is very standard. Yeah. So triple net is a type of lease. Okay. So what that stands for, there's 3 expense categories: common area maintenance, real estate taxes, and real estate insurance. And so in a modified gross, typically landlord pays all of that and tenant pays utilities. Well, in a triple net lease, tenant pays everything. In a gross lease, landlord pays everything. So you can see where that modified comes in. Really, really awesome way to do it if you're a landlord. It's just a little bit tough conversation, right? Because tenants don't want to have to pay for everything. But some of the bigger national groups expect it. and it makes it a little bit easier. You got your rent. This has been a big factor as far as annual increases on leases with CPI. A lot of people have tried to tie your rate increase per year with CPI, which right now is at like 8%. So yeah, imagine your rent going in 1 year up 8% if it was tied to CPI. In the past, 2 to 3% annuals is typical, or you have a flat for 5 and up at 10, which equals 2% a year. Always good factors. I would tell you the biggest thing in a commercial property, the gold is the lease. You need to get you an ace attorney, and you need to just comb through it as much as possible, make sure there's no surprises there. But that's really, from an investor standpoint, what you're buying in these commercial deals is the leases that are in place. If it's a value add, there's some ability for you to do some things, pull some triggers to create that additional value. Or if it's already a done deal, we joked about buying a 4-cap Taco Bell, which I'm in no position to do yet. We'll see one day. But you just can't put debt on those projects.
So it doesn't tenant what's the rent. There's no tenant fee.
Typically, you'll get a better rent deal, but some properties you don't have a choice. It's just kind of that's the one beauty for landlords in our market. I mean, every asset class is sub 5% vacancy pretty much. So it's definitely a landlord's world at the moment. We'll see if that changes, but that would be my answer to you. Yeah, let's start some questions. I'm good with that. Yeah, you too.
How long did that project take?
It was 6 years total. Bought it in 2016, exited late last year. Yeah, they were. Development partner. Yes, sir.
Background in the area, what would you say is the average market?
Ooh, you want to answer that?
I mean, I don't know, what would we sell box art for, like 4 cap?
Yeah, sub 5 for sure. Yeah, it was. I mean, the Class A stuff's trading even as aggressive as well. Yeah, I mean, it's just super competitive at the moment. You're pushing 4 everywhere. You're seeing that across the board. A lot of people, there's a difference between in place and pro forma, right? And a lot of people believe in the pro forma in this market just because how things continue to increase price-wise. And, home loans getting harder to do. 3,000 units online in the last 2 years here that, I mean, we were 99% occupied 5 years ago. It's maybe 97 now. I mean, it's just incredible the way it's been absorbed. So I think you'll continue to see rents rise, at least in the interim, just to the lackability of housing here. I mean, there's nowhere for it to go but up, really, my opinion.
Good question. So, like you mentioned earlier, the CPI is 8.3 this month, and last month 8.1 is a continual. Properties still see inflation. The 10-year treasury is 3.41, and your cap rate is, I saw one is more than a quarter. I mean, what your investor expecting? I mean, what you're expecting the funding is going to come up?
So in most of those situations, you're dealing with cash buyers, no leverage involved. They're just buying a bond. That's how I would compare it. They're buying a bond backed by real estate. The key part in a lot of those single tenant deals is realizing how hard it's going to be to replace that tenant if they ever leave. A lot of people like Starbucks, but to be honest, Starbucks is kind of a one and done building the way they do it. I mean, you can get another coffee shop, but there's no way you're going to get another coffee shop paying as much for you as Starbucks. So that's why I like the QSR, quick service restaurant, like the Taco Buenos, for example, that were vacant 3 years ago. We backfilled them with all king burritos, and rather than a $500,000 conversion cost, they $100K and they were open. Or you look at it as a new build. Today, you're paying a minimum $750 to $1 million on the dirt. Then you got another $1 million for your building. You're over $2 million already. So, we bought this one in Hardee's for $850. We felt like $250 a square foot. There's no way you could build it for that today. And so we got a tenant on board and rolled. But, we did flip it immediately, which means I have to do it as ordinary income rather than capital gains, which is going to cost us about 15% on taxes. But, it was such a good deal. We just kind of did it. Yes, sir.
Has the work from home movement affected any of your operations? office here, or is NWA kind of insulated from that, or?
I would tell you NWA is insulated from that to a certain degree. I mean, Bentonville or Walmart requires you to have office in Bentonville if you're a vendor, so that obviously helps. But we're just such a small market relative to other places, and so our product just stays full with the amount of activity we've got going on. And it's really, currently is a little bit too expensive to make the numbers work to build new office buildings. I mean, one, you've got the dirt cost that's just insane these days. You got construction costs, and then you got rising debt. So, you know, I would say like San Francisco, I mean, they've got 25 million square feet of office and 40 of it's vacant. 40%, I mean, they'll never recover in my opinion, but just a different market. Yes, sir.
With you guys help businesses scale through real estate. Can you explain the relationship of what's in it for you guys as far as buying the real estate to lease back to a tenant, and what's the benefit of a tenant that's growing?
Exactly. A little bit of that sale leaseback conversation. You know, these tenants, these companies are not really wanting to have all their liquid cash in real estate. So they'll go in, pair up with a developer that has an open book approach. They have a system, 2% spread from what they can build it to what they can rent it, and they just roll. That's why it's so hard to break into that, because it's just a trusted sphere of folks. Each state really has their own contact person for that company locally, and you really, it comes through corporate. They have a requirement. They call us. We give them 5 to 10 options, tour the market, and then find out, who's going to give them the best deal. It's usually pretty close overall if it's a good group, because everybody's wanting them and being, aggressive. But I would tell you, the best part about it is real estate guys want to use their money for guaranteed money, like a Starbucks lease, and then the Starbucks wants a real estate guy that's going to do them right, has a system in place, and can repeat it multiple times and have an open book approach. The open book approach is the biggest thing, so they know what they're getting. Yeah. Anything else?
Yeah, pretty good knowledge of Kifer. Kifer is having an effect.
Man, no, not at the moment. Tulsa and southern Missouri are the current targets. Well, let's talk after, yeah.
Good question. I think majority of the people here was like brand new to commercial investment.
Sure.
What's your suggestion for the people to start off looking at how should they prepare?
So obviously talking to brokers, I mean, they're the boots on the ground. They're the ones that are finding these deals day to day. I mean, you're not going to find anything on LootNet. I mean, you can look all you want. It's just most of those deals are, there's a reason they're on the market. I would say meet with folks like Brian. I mean, he's got a track record of enormous success. Omar, just find people in your community that have done a good job about it, and just start kind of picking their brain. That's what I did. I was a bank teller, met a bunch of these brokers that were cashing big checks, and just started going to lunch with them, man. Honestly, yeah.
So what you're saying is don't look at the LootNet, right?
Nah. I mean, you can look. It's just, it's far and few between when you find a deal on those.
It's a good practice to analyze deals.
Yeah.
What a deal like.
You can figure out why it doesn't pencil on LootNet. That's why it's on there. Yeah. Anybody else? Yeah? Am I done?
I'll ask, if someone were to enter into commercial real estate, is there a particular type of asset class that you recommend them to start with?
Well, everyone else is doing multifamily, so maybe try and figure out something else. That's tough because commercial, it's a little bit bigger of a barrier entry cash-wise. That's the hardest part. So, my way to break in was finding some bigger whales, as I say, some wealthier, older guys, go grind, find a deal, pitch them on it. They'll offer you to invest in them with them. That's kind of how, I did that with an apartment deal. I found wagers and I found it. The owner let me roll my fee into the deal as equity. And that's what set me up. It was sweet. You just don't find that opportunity. So I would just talk to as many people in the space as you can. Activity leads to more activity, man.
Zack, do you do any GPLP deals?
You're way better on that than I. I'm the deal finder, not necessarily the putter together. But yes, a little bit. I typically stay with the GP side myself. I haven't dove into bringing 20 folks in yet myself.
I was going to say, maybe that's something that they explain.
Yeah, all the time. I mean, that's another opportunity to get in the deal if you have. I think the common misconception people think is they have to have millions of dollars to take down this huge commercial project or huge apartment complex. But, depending on the project, you can get involved. Some of the stuff that I'm doing is $50,000 or $100,000. You can get involved in this larger project, as an LP, where we carve out. When we buy an apartment complex, generally about 30% of the GP team, so those are the guys that are finding the deal, operating the deal, seeing the exit, seeing property management, overseeing any sort of construction and lending, and then the investors are 70% owners. So that equity that's needed to take down that deal is carved out for the LP. So they're limited partners, but they're involved on it. They can see the processes. They get monthly reports. They can get kind of a taste of that commercial experience.
It's a great way to get your feet wet with somebody that knows what they're doing, so you don't get in trouble real quick. It's good to get your feet wet. I would say that for sure with someone else first. Personally, I would recommend that. Usually 50 to 100K is the minimum on commercial deals, I would say.
For our deals, it's usually 50 to 100K. So you don't have that. You try to figure out a way to get, the first 100K is always your hardest. And there it's a lot easier.
Yeah. And also for those that don't know, GP and LP, GP is general partners. We're the ones that put in the sweat equities, leverage their expertise, capital, take the risk. LP is the limited partners, also passive investors. Just kind of breaking down the terminology because I know not everyone is familiar with it.
For sure.
And also, there's accredited investors, non-accredited investors that can qualify you to get tax opportunities as well. And whatever contact that would go through any time.
Sure. Yeah. Cool.
So what's a way that people can find out how to evaluate these performance and everything? Like there's all these different Excel documents.
There is, man.
Sound like gibberish.
And I would tell you personally, I've had a ton of success with YouTube. You got every raise funder in the world kind of doing their thing as far as getting their word out on what they're doing. So you can find videos all over YouTube they'll walk you through the whole thing. You can become an expert rather than, spending a ton of money on a degree or classes. I would start with YouTube. Just Google whatever you're interested in.
With these increasing interest rates, how is it affecting the cap rates? Because that affects your return.
It does, man.
And your spread also.
So it's obviously raising them a little bit. It's all based on tenants' credit. There's still, a Chick-fil-A goes up for a 3 1/4 cap in a major market and in a major intersection. You're still going to have 20 people trying to get it for 3 1/4 cap. You're not even going to.
Because those are all cash buyers.
Correct. Yeah. The triple net deals are like that. The multifamily, when the spread starts shrinking up a little bit, they're going up. It's just a matter of how much. Your market determines that a lot too, and we've got such a competitive market here that it necessarily hasn't hit yet. That's the biggest thing right now, in my opinion, is buyers' expectations and sellers' new expectations haven't matched yet.
Yeah, because all the deals that were done like 3 years back, those are on the market. Those were done at certain cap rate, and now with increasing interest rates.
Exactly.
Yeah.
That's why we think there's going to be some opportunity here in the near future. We'll see. Yeah, that's the golden egg, man. I don't know. You got any thoughts on that?
Yeah, interest rates go up. I think the past couple of months, like a couple months ago, sellers' expectations were so high. Debt was still increased. Like sellers' expectations hadn't met the debt, but I think we're seeing now, some sort of some sort of correction, where it's starting to come down. I'm not involved in the single family market, but I'm hearing instead of 12 offers in the same day, they might get a couple offers,
For sure.
a little bit longer. But if you look at historically, I think the average time a home is on Zillow is for like 1 month or 2 months, like a couple months, So it's like people are so used to this high volume, market. But commercial real estate is have started to come down. Some of the stuff that I'm selling, we reduced the price on a little bit, from what we were getting in January. We're not getting the same prices as we are now. But it's still great return. But if there's cap rates, I think you will see them start to increase.
Yeah, they're going to have to,
People won't be able to buy that. But there is a lot of money chasing commercial real estate right now because of inflation. It's a lot better place to have your money in a hard asset like real estate. So it kind of insulates itself from those interest rate changes because it's a hedge against inflation. So with inflation going that way, there's going to be more capital, large check writers putting their money into real estate despite this. So that kind of hedges against it a little bit.
So now the inflation is at 8+. So like 3 years down the road, if the inflation is less than 5%, do you see the interest rates also going down?
Yeah.
That will affect cap rates also in the future.
Yeah, I don't have a crystal ball, but I think I don't think interest rates can continue to rise for the next 6 to 12 months. Without, I think we'll hit a recession. I think we're pretty lucky to be in Northwest Arkansas. I do think we are, in a bubble of some sort, like protected from the rest of the country. So that's me and an investor in other markets. I'm super specific at what markets I'm investing in. You mentioned California. I won't touch California with the 100, but we won't invest in the Northeast. As far as north as I'll learn like the Midwest, but I think it's really market specific. But I think interest rates do come down in the next 6 to 12 months. But we've seen interest rates at like 15% before, but I don't think they go to that at all.
And just to add kind of the interesting phenomenon, the rates started really increasing the last quarter, like summer. We had some deals, like we got under contract in April, like closed until like July, and then there was so much changes in interest rates. Like we had to essentially go back to the seller, which is not always looked favorable upon, but we wanted to get investors return, so we had to go back to the seller and ask for a lower price to the investors return. Sometimes that happens. She wouldn't let me go earnest. So it's kind of in the commercial real estate space, some of the risks you have to take with your business partners. And going back to the interest rate and overall commercial real estate, I just want to add, because a lot of us are familiar with my family, all of us have rented a house at some point, so we have a different market. But if you look back into commercial real estate, I think it's important to have a bigger scope. We have the different types of assets. For example, build-to-rent is really hot right now. Institutional investors invest a lot of money in that space because cost of build is so much cheaper than buying an existing place, especially in the high-growth markets like Atlanta, Phoenix. So look at the different options and look at investing in those. Some people are passionate investors. Some people want to build the equity faster. So, experts like Mrs. Tucker and Dr. Bryan and some of us working in the space, like we wanted to take that one holistic view and look at the return a little bit versus like I want our returns. It really is more of a conversation when it goes out and then we have the numbers. I know it's a little bit off topic to interest rate, but I just want to reflect on that numbers, but it really starts with you first.
What are you guys seeing as far as outside investors, out-of-state investors starting to park their capital?
More than ever, man. More than ever. It's crazy.
Can you explain maybe why that is?
So the dollar per square foot, that's the easiest way to look at it. It just goes a lot further than markets like Dallas, even Tulsa, KC, St. Louis. Those markets are so stagnant. They're not super stagnant, but compared to us, they are. And so those people are looking for bigger returns. They're looking to come in and develop. They see things that are in our market because we're such a small that are needed. And so it's just a hunt to find that, whether it be, land to build some industrial, because our industrial sub 1% vacancy. I mean, it's crazy. If you're a tradesman, you cannot find a warehouse. You just can't. And the caveat to that is to build more. Well, you can't really build more because it's gotten so expensive and people aren't willing to pay that rent that's needed to make it a return that's doable. So we'll see how the next 5-10 years go here. I feel like it's headed in the right direction. The outside circumstances may affect us a little bit, but I describe NWA to people a lot of times. You got 4 cities, right? You've got your 4 pillars. You got Fayetteville, you got the U of A, you got Springdale, you got Tyson Foods, you got Rogers, Lowell, J.B. Hunt, and then you got Bentonville, Walmart. I mean, what other market can talk like that? I mean, it's just, I mean, they can, but we're such a small place compared to a Dallas that it's awesome. I mean, I just see a great runway through the future. And the great thing about it also is each one of those players is investing so much back into this market to make it a better place for all of us. So I'm pretty bullish, you know. I'm obviously biased, but.
So I have a question. When you talk about your stores coming down, how much are you seeing they coming down? By how much?
I don't know if I can necessarily put a number on that yet. I mean, it's at least a consideration at this point instead of a no. That's the best way I can describe it.
So the list price is the best.
Never.
So you're saying like 300,000.
Depending on the deal. I would be uncomfortable to tell you just a set amount, but it's at least a consideration at this point, where in the past they would have told you to like go kick rocks if you're 500K below the offer. Now they might split the difference with you, you know. There's at least a conversation to be had now where prior there was not.
Well, I think right now it's like 6% cap rate, and then it might have to.
Yeah, I mean, it's tough for sure. You're going to have to reach to get a deal in NWA right now, in my opinion, unless you just get lucky. So it's.
What kind of cap rate are you talking?
I mean, if you can find an A cap, buy it every day, all day, in my opinion. But 10 cap's unreal. Yeah, I haven't seen that in years. Like I said, we built that King Burrito to a 9.43 cap. I would do that every day of the league for the rest of my life, you know. I would say anything above 8 is super attractive, personally, depending on the asset. It all comes down. I mean, your cap rate's based on the asset, it's based on the tenant, and it's a variety of different things, but the heaviest weight factor is the tenant's credit.
Yeah, and I also think it depends on the asset class, because we work on a portfolio deal where we had Class B and Class A. The Class A, we're able to negotiate after got into contract, we're able to negotiate like another 3% for Class B, which would be less, because it's more attractive with them.
For sure.
I think it really depends on the asset type and asset class.
Agreed. You got to find the story to tell. Why is the deal a good deal? You know, you can figure out the reasons typically of what levers you can pull and make it a good deal. There's always a way to bring some upside some way. Just got to roll your sleeves up. Hardest part's finding the deals. That's why you got to get with your local brokers. Not just me. You got to talk to them. You got to see what's going on. Talk to your bankers. Talk to people you know have made money. You know, there's a reason they've made money. They figured something out. So just try and pull notes from them. Cool. Any other questions?
How do taxes play into it? So, like, maybe an investor, you may not have the best cap rate, but the investor that you're working with, they may be incentivized to make a deal. Can you talk about some reasons why they might do that?
So at 10:30, it was a little bit of my deal, right? So the King Burrito deal, I sold it within a year, so I had to realize it as ordinary income, which is taxed at approximately 40%. Well, if I would have held it for a year, that comes down to, I believe, 15%. So that's a big spread there that you're giving up. But there's also the phrase "take your money and run." Sometimes, and so that's kind of where we were on that. King Burrito's a great client, but at the end of the day, you don't know if they're going to be there for the full 15-year term. So it was in our best interest to just exit and cash in and go on to the next deal.
Yeah, for taxes for us, we do what's called cost segregation. So, historically, you can appreciate rental at 27 and a half years, but because we do cost segregation, we're able to bonus depreciate that. We can capture a lot of that in the first year, and then some spread out in the next 5 to 7 years.
And bonus.
So, for example, we just finished all our K1s, and on average, for every $100,000 that was invested in our syndication, we had an average of $150,000 loss that they were showing for that bonus depreciation. Even though we were pushing rents and putting this money back into the apartment, we were able to show on paper to the IRS a negative $150,000 loss for that. but they are phasing out bonus. The current administration is both phasing out bonus depreciation. So this year is the last year for 100% bonus depreciation. So those tax benefits are slowly going to dwindle down. So next year it's 80%. The year after that it's 60%, and it's going down 20% every year. Current until that gets voted to change. I don't think it'll change anytime soon. So that's slowly being phased out.
1031 is a huge term in the commercial world. I mean, it accounts for probably 30-40% of deals a year. Basically, a seller sells his property rather than realizing all that income, they instead defer it. You have 45 days to identify, and then 125 days after that, I believe, if I'm not wrong. There you go. There we go. That was a test. You got that to place it, and then you don't get away with that tax forever. It's just deferred. So oftentimes you'll have 1031 guys. You start in a $250,000 duplex, then you get to an 8-plex, go 500K, then you get to an 18-plex, $1 million. You just keep rolling that, and at the end of it, if you keep doing that, you're deferring so much tax.
Just think about that way, how the Trump view is profit.
Yeah, there you go. I like it.
And a lot of you may be real estate professionals that can take advantage of like all the depreciation that mentioned. I assume you're probably a real estate professional.
For sure.
Yeah, so all of them pay little to no taxes.
Brad, next time should come up with a class on how the tax depreciation. So look at how to save the tax on that part.
Agreed.
Yeah.
We're taking notes.
Feedback.
Yeah, for sure. All welcome. Cool. Anybody else? Yeah.
Kind of a different question. Now let's deal with commercial. We deal with a lot of industrial heating third parties with 75, 69, 40, and 49 over there. Do you see any truck parking going up in the industrial area? Because not having to build a building on there for something like that, just gravel and a fence. Do you see any truck parking happening here in Compton?
Yeah, personally, no. I mean, I haven't dealt in that space a ton. I would tell you the majority of folks that have a ton of tractor trailers here have the property already where they're going to be sitting. They're usually, I mean, if a trailer's sitting still, it's not making money, right? So the majority of them try to keep them in flow, keep them in distribution centers. So I would say I don't see a ton of that. Yeah, another one. Cool. Everybody good? Yeah. I don't have to have a clap. It's all good.
Awesome. Lenny, if you want to kick next slide for us. If you want to learn a little bit more about just commercial real estate or passive investing, both Brian and I will have our website that you can go to. Mine is 110 questions you can ask before investing in real estate syndications. Brian has a few of them as well. One of them is multifamily in the stock market, which I can let you talk a little bit more about as well. My website information is on there, lifemissioncapital.com ebooks, and his is on there as well. I know he has 2 different companies that he works under, with the latest being Elevate. But I want to tell you a little bit about the next workshop we'll have. We're planning on doing this monthly, and with the goal of making it a tri-state conference for the area and bring more opportunities for everyone. So if we can go to the next slide. We're going to have this event. We don't know where yet, so make sure you're either on mine or Brian's list. We'll go to meetup.com, look up Northwest Arkansas Commercial Real Estate. We're really going to grow that meetup group. So it's going to be, we're trying to set a fixed schedule, and so far we've decided on the 3rd Tuesday of every month. So the next one is going to be Tuesday, October 18th, and we're going to have Dave Pinson. He was the CEO of Trinity, and also now Trinity being property management being acquired by Asset Living. He now works for them as well. And I'll let Brian give a closing as well as doing an intro of Dave and why it's so exciting to hear from Dave.
Yeah, for sure. Yeah, Dave Their Trinity is based in Fort Smith. They've managed about 1,500 units for me. They've managed all the way from Fort Smith, about 500 units of my personal property, and then some property that I partnered on in Oklahoma City and Oklahoma. They actually currently manage one that we're under contract in Centerton. So we're going to see if we can maybe get this event possibly at our location in Centerton. So maybe you guys can see a unit, kind of walk around the apartment that we're under contract to buy. So still figuring out the logistics on that, but definitely a guy who helped grow a business, ultimately saw an exit, and we're excited to talk to him about property management, what owners should be looking for, what that relationship looks like. So excited to have him here, and I'm really excited to start this event. I feel like this was a big need for Northwest Arkansas that Micy talked about. There's a lot of stuff for the single family space, but the commercial space is a really growing space, and I think we can really tap into it being here local. There's a lot of interest that was mentioned out of state, but I think the more control that we can have in state, it definitely feels good to do deals in your backyard, as an investor. So excited to, collaborate with each other and really bring this opportunity to network and see how we can help each other. So really appreciate you guys coming out. I'm going to stick around. If we haven't got to know you, just come up to me and we can meet. I don't know if you have anything else.
No, feel free to network, hang out with us, everybody else. I think we're going to be good here for some time, so just hang out. Feel free to leave if you need to leave. Well, hope to see you next time. Let's bring a friend next time too, right? So hope you guys enjoy it. If you have any feedback, feel free to let us know as well, ideas, etc. Thank you so much for coming.